Hello and welcome to Livewire Markets. My name is Anna Dadich. Today I'm joined by Kevin Bertoli of PM Capital to chat about the global equity landscape against what they call is a structural reset of the global economy. Welcome, Kevin.
Anna, thanks for having us.
Thank you for joining us. So let's unpack that intro right now. In your recent portfolio update, you said that we are currently undergoing what is a structural reset in the global economy, decades in the making, but also decades to unravel. Can you unpack that for us now, and what does it mean for investors?
Yeah, so we've framed this conversation around the topic of deglobalisation. And if you actually look at where we are today in this trend of deglobalising, we really need to look back at the last 25 to 30 years to understand where we've come from, how long that change took, that shift towards a truly global economy. At the heart of that was China as a global manufacturing base. It started with China entering into the WTO in 2001, and they've really taken that initial entry and the strength that that's built in their economy around manufacturing, and really developed more than just a manufacturing powerhouse, but they've taken that and they've leveraged that into economic power globally. They're looking at technology leadership, security leadership, these issues. So that's a trend that's taken 25 to 30 years to evolve. And now we're at a point where that trend, we think, is at the precipice of shifting and reversing. So just like that took 25 to 30 years to truly develop, there was a lot of opportunity along that journey for us as investors. We don't think this is a Trump phenomenon. We think this deglobalisation trend and the shift from the power base to nationalists over globalists is something that will play out not over 12, 18, 24 months or Trump's term in office, but something that's going to play out over a 10, 15, 20-year period. And that's going to create a lot of opportunity for us as investors to take advantage of.
Okay, so how are global valuations looking to you right now?
So if you look at 2025, we've experienced a rapid shift in markets. It was 6 to 8 months ago that we had Liberation Day, where there was a lot of uncertainty around what's happening from an economic growth perspective and maximum fear around what impact tariffs will have on growth. If you come to today, investors have pushed that to the side and are clearly less worried about things that are still embedded day to day in doing business, which is tariffs. So clearly what's driving markets are some of these big, broad, structural thematics, the number one being AI. And that's really pushed the market higher. So where we sit today, you've got record valuation, you've got share prices at all-time highs, and you've got volatility levels at record lows. So a huge shift. But interestingly, what we've been able to identify is you've had a lot of bifurcation in markets. So things that have performed very well for us in our portfolio, we've been able to actually exit out of those positions, rotate into sectors where they're actually very depressed. And when we say very depressed, we're talking valuation at 10 to 15-year lows, and share prices that are off 50, 60% from their highs. So pharmaceuticals is one space. Global beverage is another space, and anyone that's followed PM Capital knows that that's an area that we've been invested in heavily over the last 20 years.
Okay, so Europe features heavily in your recent update. Why are you finding opportunities there that others might be overlooking?
Yeah, it's a good question because we often get a lot of pushback when it comes to Europe. It's very easy to read the headline that might be French political disarray. And every time someone travels to the UK, they have trouble getting on a subway because there's a strike. So there's a lot of negative news flow when it comes to Europe. The other factor is it's a market that people haven't had to be overly worried about because it's meandered along over the last decade and a half. And with the US being 70% of the index, most investors have said, well, we don't really need to worry about that. But I think the re-emergence of Trump in 2024 is a big catalyst for Europe. European leaders are actually, goes back to my point before around this deglobalisation trend. European leaders have been forced into having to act. If you look at Russia-Ukraine, it was a huge transition for them in terms of energy. And then the re-emergence of Trump has brought back into focus maybe our largest and longest serving partner may not be the friend that we thought they were. And I'd point to a conference that happened in November last year. It was a European Leaders Summit. And Emmanuel Macron, he got up and he spoke about this issue. And he actually titled it Herbivores and Carnivores. And he talked about the global landscape in the term of there are countries that are carnivores, the Americans, the Chinese, and then there's countries that are herbivores. And historically, it's been European countries. And if Europe continues to go down the path that they've gone down in the last 20, 30, 40 years of basically outsourcing security, economy, technology to the US or China, you're going to turn around in 20 years' time and you're going to realise that the carnivores have come in and they've eaten the herbivores. So Europe has to act today, and there's a real recognition amongst politicians for that and that needing to happen. So we like the framework and the setup there, and we think that's something that is, again, a structural shift in the opportunity set in Europe.
Yeah, sure. So which themes or sectors are driving your portfolio today, and what's underpinning your conviction in these areas, and how are you currently positioned?
Yeah, so if you look at two of the big ones in our portfolio, we've had European banks, which plays off of that European story. Now, European banks are going to be a big beneficiary of greater activity in Europe. You know, European leaders now know you need a healthy banking system to drive economic growth. So the outlook is stronger, you know, rates have normalised, loan growth's coming through, but valuation is still well below other developed market banks. So we continue to like the European banks. European industrials and industrials more broadly is a space that we really like. We've got businesses like Siemens, global reshoring beneficiary, SPIE, which is a technical services business. Those are playing off of some of these big mega trends that we see playing out over the next decade. And the third really important one when we look at this globalisation trend that's happening is what has been clearly highlighted over the last 6 months is commodity security and scarcity is definitely in focus. There's a clear recognition of which countries have access to the right critical minerals and who doesn't. And a lot of people will talk to China and the One Belt, One Road policy being unsuccessful. But if you actually look at what that did for China over a long period of time, they now control resources in Africa. So there's a recognition from the West that there is a shortage of critical minerals and commodities that we're going to require. We've got big positions in copper playing off the back of that. And it's really a play to say supply is short, it will continue to be short, and people are going to start fighting for these resources. So we want to be positioned for that play. Mm-hmm.
Can you name one or two holdings that best capture your investment thesis right now?
Yep. So I can give you a long-held position, which has been playing out nicely, and then I'll give one that's a newer position in our portfolio. So Siemens, I mentioned before, is at the epicenter of this global reshoring, deglobalisation story. So if you look at the Siemens business, it's got 3 or 4 big divisions, but industrial automation is their biggest business, and then they've got a very big and important healthcare business. But if you think about resetting the global supply chain and fragmenting it and reshoring back into either the US or Europe, you undo the benefits of globalisation, and that's scale in China at low cost. So if we want to bring manufacturing back to places like the US, like Europe, you need companies like Siemens to automate process. So we think that automation play within the Siemens business is going to be a long-term driver of their earnings growth story. We've owned that since 2018, 2019. The stock's comfortably doubled from where we bought it, but we think that business can continue to compound at high single-digit, low double-digit rates in terms of earnings and cash flow. And it trades at a significant discount to the US comparables like Rockwell. So that's one we like, and we continue to like that. A new position in the fund, bought over the last couple of months is Union Pacific, which is the largest Class 1 rail operator in the US. Now, interestingly, again, that business is one that should benefit from a global reshoring story, but there's an added layer on top of that. and that is consolidation in the rail sector in the US. The way that the US rail sector operates today is you have two West Coast and two East Coast operators. So if you want to send cargo across the nation, it's very inefficient and it loses a lot of share to truck. So two of the biggest operators have proposed merging together. Now, historically, it's been very hard to merge these businesses because of regulation. But what is more MAGA than having an intercontinental railway in the US? I can't think of one. So it's very well positioned, if that transaction can go through, to structurally shift how this business grows volume by taking share from truck.
Okay. So can you also talk about a holding that you've trimmed recently or exited?
The capital that we've invested into Union Pacific comes from the sale of Airbus. Mm-hmm. So Airbus is a position we initiated, and PM Capital is a very long-term investor. So we initiated a position in Airbus during COVID. Now, clearly, COVID is not the ideal time for someone that makes airplanes. But our view was the market's reaction to the COVID pandemic suggested that the business was never going to recover. And it was happening at a time where the competitive landscape between Boeing and Airbus was shifting. Airbus had the A380, which, while a lovely plane to fly on, was actually a very inefficient plane if you were an operator of the plane. And then they've got the A320 line, which is hugely profitable for them. So they've discontinued the A380 and they focused on the A320 airframe and its iterations. Now that's improved profitability. And as COVID has dissipated and people have become less concerned about that, the stocks have re-rated. We're now getting to a point where that thesis has played out. There are potentially still issues in the supply chain related to the ability of manufacturers to get components. So with that risk and where valuation sits today, we're comfortable selling out of that position and going to focus somewhere else.
Kevin, given geopolitical tensions, fiscal deficits, shifting global trade, what risks are you most conscious of right now, and how are you ensuring the portfolio remains resilient?
Yeah, so to start with, for us to ensure our portfolio remains resilient, we always come back to the building block of what we're doing day to day, and that's identifying valuation anomalies. Mm-hmm. So we're very comfortable selling positions when they reach our valuation criteria. And then if the stock goes up from there, it goes up from there. But we're going to remain disciplined, and I think that helps protect the portfolio. When you talk about risks, there's always risks in market, and the hard part is the risks that you don't see are the ones that drive the biggest corrections. But one of the things I would flag anecdotally is that big shift we spoke about in the first couple of questions in terms of how quickly the market's changed, where valuation is today, where expectations for earnings are today. So you can have a shock to markets, and that's been driven by this weight of money that has flown into AI, which is a big trend. And one of the observations that we've made is a lot of this conversation that's been had around this topic. It is hard for us to say with clarity how this is going to play out, but what is very clear is there's been a lot of capital that's been allocated, and that allocation of capital has happened without much discussion around valuation and return on invested capital. So eventually, when the music stops, I'm not saying there is not good investment being made, but there's a lot of investment being made, and it's particularly pronounced in that space. And when that happens, you tend to get pockets of misallocation of capital. And I will share one quote, which was from Mark Zuckerberg, and he talked about the risk of overspending by a couple $100 billion was less risky for him if he was to overspend than to underspend. Now, a couple $100 billion is greater than the market cap of most companies in the S&P 500. So we're talking astronomical figures. And those figures are so large because it's not just companies in the US competing against one another, it's companies competing against China. And a race to beat China often comes without any consideration for valuation or return on invested capital. So I think that's a big risk that we need to factor in, not just over the next 6 months, but the next 6, 12, 18, 24 months, because eventually that will become a focus.
Okay. So finally, what do you think will drive global equities over the next few years? And where do you see the most compelling long-term opportunity for investors?
Yeah. Ultimately, I think earnings growth will always drive equity markets. Obviously, you've got the valuation piece that comes along with that. But if you actually look how it typically works, is you identify valuation mispricing, you're correct on reappraising how fast a business can go. And as the market catches up to that and they grow faster, the valuation re-rates. Where we sit today, companies, particularly the big end of town, the Mag 7, the top 10, they've been able to execute quite well and they're being afforded very high multiples for that. If they don't grow, then earnings growth will slow and the multiple will derate with that. So that's the setup, and I think that's what will drive. But there's plenty of opportunity in markets. It's a very broad market. There's thousands and thousands of stocks. So looking for pockets where valuation makes sense, where the businesses can grow or they can inflect and grow again, I think is really important. So some of those examples that we talked about, whether it's a Union Pacific or some of the European industrials, commodity companies, we think there's plenty of value there for investors to take advantage of over the next couple of years.
Okay, thanks Kevin for sitting down with Livewire today.
Thank you.
If you enjoyed that interview, make sure to give it a like and don't forget to subscribe to our YouTube channel. We release new content every week.